Getting ready for your real estate exam? Birdsey has you covered with a series of videos covering everything you need for exam day. This is National Part 3, focusing on real estate finance, valuation, and settlement. And be sure to pay attention to what's in the bottom corner of the screen. It will be key to your prep. We'll explain more about that in just a minute. Now, let's get started.
Let's continue with an examination of real estate finance. We'll begin with types of loans and mortgages. What is a fixed-rate mortgage? Is it A, a mortgage with a fixed interest rate for the loan term? B, a mortgage with an interest rate that fluctuates monthly? C, a loan with no interest rate? Or D, a mortgage that can be refinanced anytime without fees? The answer is A, a mortgage with a fixed interest rate for the loan term. Fixed-rate mortgages have a consistent interest rate throughout the term, offering predictable monthly payments. This stability makes them popular among long-term homebuyers. Source: National Mortgage Licensing System. Which of the following best describes an adjustable-rate mortgage? Is it A, a mortgage with consistent interest rates? B, a short-term loan with no interest charges? C, a mortgage with interest rates that adjust periodically based on an index? Or D, a loan that can never be refinanced? The answer is C, a mortgage with interest rates that adjust periodically based on an index. Adjustable-rate mortgages have interest rates that vary based on a financial index. This can lead to changes in monthly payments, often starting with a lower initial rate. Source: Federal Reserve's Consumer Information.
Have you noticed the code in the bottom corner? Next time you're stumped, take that code to birdsey.ai for immediate help and a free study session with Birdsey, your personal AI study partner. Plus, you'll get access to hundreds of additional questions, helping you move closer to passing your exam with confidence. The next time you're feeling unsure or stuck, give it a try.
What is a major benefit of a VA loan? Is it A, it requires a large down payment? B, it offers reduced closing costs and no private mortgage insurance? C, it is only available for investment properties? Or D, it is exclusive to first-time homebuyers? The answer is B, it offers reduced closing costs and no private mortgage insurance. VA loans, backed by the Department of Veterans Affairs, benefit eligible veterans by offering reduced costs and no requirement for PMI, easing financial barriers to homeownership. Source: U.S. Department of Veterans Affairs. Which type of loan allows for an interest-only payment option? Is it A, interest-only mortgage? B, conventional fixed-rate mortgage? C, government-insured mortgage? Or D, graduated payment mortgage? The answer is A, interest-only mortgage. Interest-only mortgages allow payments solely on interest for a preset period, reducing initial costs but without principal reduction during that time. Source: Consumer Financial Protection Bureau. What characterizes a balloon mortgage? Is it A, a revolving credit agreement with no set maturity date? B, a mortgage that fully amortizes over 30 years with no large payments? C, a loan designed to gradually increase payments over time? Or D, a mortgage that has a large final payment due at the end of the term? The answer is D, a mortgage that has a large final payment due at the end of the term. Balloon mortgages feature lower monthly payments with a lump sum balloon payment at term's end. This structure can be risky if not planned for appropriately. Source: Federal Housing Finance Agency. What is a characteristic feature of a fixed-rate mortgage? Is it A, interest rate varies over time? B, interest rate remains the same over the loan term? C, loan term is always 15 years? Or D, payments decrease over time? The answer is B, interest rate remains the same over the loan term. Fixed-rate mortgages have an interest rate that remains unchanged over the life of the loan, offering predictability in monthly payments. This contrasts with adjustable-rate mortgages. Which of the following is true about an adjustable-rate mortgage? Is it A, the interest rate is locked for the entire duration of the loan? B, the interest rate adjusts periodically after an initial fixed period? C, they are only available for short-term financing? Or D, they guarantee a lower overall interest cost than fixed-rate mortgages? The answer is B, the interest rate adjusts periodically after an initial fixed period. ARMs have an initial fixed-rate period, after which the interest rate adjusts periodically based on agreed indices and terms specified at the outset. In which scenario is a jumbo loan most likely required? Is it A, purchasing a home with a high market value exceeding conforming limits? B, buying a modest starter home within standard market limits? C, refinancing a small suburban home to reduce interest rates? Or D, acquiring a rural property with government-backed financing? The answer is A, purchasing a home with a high market value exceeding conforming limits. Jumbo loans are used for home financing when the purchase price is above the conforming loan limits set by the Federal Housing Finance Agency, typically needed in high-cost areas. What is the primary feature of a reverse mortgage? Is it A, the borrower receives monthly payments from the lender? B, the borrower pays a variable interest rate and monthly principal? C, the borrower is required to pay only interest for an initial period? Or D, the borrower needs to refinance every 5 years? The answer is A, the borrower receives monthly payments from the lender. A reverse mortgage allows homeowners, typically senior citizens, to convert part of their home's equity into income without having to sell the home or make monthly payments. Loan qualification and application process. Which of the following is not considered when determining a borrower's debt-to-income ratio? Is it A, monthly rent payments? B, student loan payments? C, car loan payments? Or D, child support payments? The answer is A, monthly rent payments. Only applicable monthly debt payments and obligations such as loans, credit card payments, and alimonies are considered in the DTI ratio. What does a lender primarily assess when conducting an underwriter review? Is it A, real estate trends? B, property location? C, market interest rates? Or D, borrower's credit score? The answer is D, borrower's credit score. Underwriters focus on the borrower's ability to repay the loan, which is significantly influenced by their credit score, income, and DTI ratio. Which document outlines the interest rate, loan amount, and monthly payments in detail? Is it A, purchase agreement? B, loan estimate? C, appraisal report? Or D, credit report? The answer is B, loan estimate. A loan estimate is issued by lenders to illustrate the terms of the loan, aiding borrowers in understanding and comparing loan offers. Which factor directly affects the interest rate a borrower pays on a mortgage? Is it A, neighborhood facilities? B, property size? C, borrower's credit score? Or D, time of year? The answer is C, borrower's credit score. Lenders use the borrower's credit score to assess risk. A lower score typically results in a higher interest rate due to perceived risk. What is the primary benefit of a pre-qualification letter when applying for a mortgage loan? Is it A, it guarantees loan approval? B, it gives an estimate of the loan amount you might qualify for? C, it locks in the interest rate for the mortgage? Or D, it is required to make an offer on a property? The answer is B, it gives an estimate of the loan amount you might qualify for. A pre-qualification letter indicates how much a borrower might be able to borrow based on a preliminary review of financial data. It's an initial step distinct from pre-approval. Which document is typically required during the mortgage loan application process to verify employment history? Is it A, credit report, B, W-2 forms, C, bank statements, or D, property title? The answer is B, W-2 forms. Lenders often require W-2 forms as proof of employment and income. This helps them assess the borrower's capacity to repay the loan.
If you're finding this helpful, please take a minute to like this video and subscribe to our channel for more practice exams, useful tips, and complimentary study sessions with Birdsey.
Government programs. What minimum down payment is required for an FHA loan? Is it A, 10%, B, 5%, C, 3.5%, or D, 15%? The answer is C, 3.5%. FHA loans require a minimum down payment of 3.5% for borrowers with a credit score of 580 or higher. This makes homeownership more accessible for those with lower credit scores. Which of the following is a feature of a VA loan? Is it A, no down payment required, B, strict income limits, C, only for new home purchases, or D, available to all U.S. citizens? The answer is A, no down payment required. VA loans are a benefit provided to veterans, allowing them to purchase a home with no down payment, making it easier for them to achieve homeownership. What is a key eligibility requirement for a USDA rural development loan? Is it A, property location in a rural area, B, maximum loan amount of $300,000, C, 20% down payment, or D, minimum income of $50,000? The answer is A, property location in a rural area. A USDA rural development loan requires the property to be located in a designated rural area to qualify, allowing for no down payment for eligible buyers. Which program offers mortgage insurance to protect lenders against borrowers' default? Is it A, conventional, B, U.S. Department of Veterans Affairs, VA, C, U.S. Department of Agriculture, USDA, or D, Federal Housing Administration, FHA? The answer is D, Federal Housing Administration, FHA. FHA loans come with mortgage insurance that lowers the risk for lenders, thereby empowering them to lend to more individuals. What is the maximum seller concession allowed on an FHA loan? Is it A, 3%, B, 6%, C, 9%, or D, 10%? The answer is B, 6%. FHA allows seller concessions up to 6% of the purchase price, helping buyers cover closing costs and lowering the overall expense burden. Which government program is specifically designed to assist veterans in obtaining housing loans? Is it A, Federal Housing Administration, FHA, B, U.S. Department of Veterans Affairs, VA, C, U.S. Department of Agriculture, USDA, or D, conventional? The answer is B, U.S. Department of Veterans Affairs, VA. The VA loan program, provided by the U.S. Department of Veterans Affairs, offers benefits such as no down payment for veterans, active duty service members, and certain military families. Which government program offers loans to low-income households for properties in rural areas? Is it A, Federal Housing Administration, FHA, B, U.S. Department of Veterans Affairs, VA, C, U.S. Department of Agriculture, USDA, or D, conventional? The answer is C, U.S. Department of Agriculture, USDA. The USDA loan program aims to improve quality of life and boost economic development in rural America by offering affordable mortgage options to low and moderate income applicants. Mortgage markets and regulatory bodies. What is the primary purpose of the Real Estate Settlement Procedures Act? Is it A, to regulate interest rates on mortgages? B, to require disclosure of closing costs and eliminate kickbacks? C, to determine mortgage eligibility criteria? Or D, to set maximum loan amounts? The answer is B, to require disclosure of closing costs and eliminate kickbacks. RESPA ensures that homebuyers receive disclosures about the real costs of the settlement process and prohibits kickbacks in real estate transactions. Which agency enforces regulations related to consumer credit protection in the mortgage industry? Is it A, Securities and Exchange Commission? B, Federal Trade Commission? C, Consumer Financial Protection Bureau? Or D, Office of the Comptroller of the Currency? The answer is C, Consumer Financial Protection Bureau. The CFPB oversees and enforces federal regulations regarding mortgage credit education, ensuring transparency and fairness for consumers. What does the acronym QM stand for in the context of mortgage loans? Is it A, qualified mortgage? B, quick market? C, questionable mortgage? Or D, quantitative margin? The answer is A, qualified mortgage. Qualified mortgages are loans meeting specific standards and providing protections to lenders and borrowers, reducing risk of lender losses from defaults. Which type of mortgage entity purchases loans on the secondary market and is regulated by the FHFA? Is it A, credit unions? B, Freddie Mac? C, retail banks? Or D, mortgage brokers? The answer is B, Freddie Mac. Freddie Mac is a government-sponsored entity that buys residential mortgages, thus providing liquidity in the mortgage market and operates under FHFA regulation. Which regulatory body oversees the mortgage-backed securities market in the United States? Is it A, Consumer Financial Protection Bureau? B, Federal Reserve? C, Securities and Exchange Commission? Or D, Federal Housing Finance Agency? The answer is C, Securities and Exchange Commission. The SEC regulates the securities markets and protects investors, making it responsible for overseeing mortgage-backed securities. This ensures transparency and legal compliance. What is the primary purpose of the Federal Housing Finance Agency? Is it A, manage the national housing financing systems? B, create housing policy? C, regulate Fannie Mae and Freddie Mac? Or D, insure mortgage loans? The answer is C, regulate Fannie Mae and Freddie Mac. The FHFA is tasked with overseeing Fannie Mae, Freddie Mac, and the Federal Home Loan Bank System to ensure stability in the U.S. residential mortgage markets.
Notice the code in the corner? When you're stumped by a question, enter it at birdsey.ai for immediate help. Enjoy complimentary study sessions and access to hundreds of additional questions to help you pass your exam with confidence.
Underwriting. What is the primary purpose of underwriting in real estate finance? Is it A, to assess the property's market value? B, to determine the risk of the loan application? C, to forecast market trends? Or D, to secure insurance for the loan? The answer is B, to determine the risk of the loan application. Underwriting involves assessing the loan applicant's ability to repay the loan and the risks associated with the loan. It is a critical step to protect the lender. Which factor is typically analyzed during the loan underwriting process? Is it A, credit history of the borrower? B, weather trends in the area? C, annual property festival schedules? Or D, architectural style of the property? The answer is A, credit history of the borrower. Underwriters evaluate the borrower's credit history to assess the likelihood of loan repayment. A strong credit history suggests lower risk for the lender. How does a debt-to-income ratio impact underwriting decisions? Is it A, it helps to set interest rates? B, It indicates the borrower's financial health. C. It evaluates the property's location risk. Or D. It predicts future real estate trends. The answer is B. It indicates the borrower's financial health. The debt-to-income ratio helps underwriters determine a borrower's ability to manage monthly payments and repay debts, thus indicating financial stability. Which of the following is not typically considered by underwriters? Is it A. Borrower's employment history, B. Borrower's hobby preferences, C. Property appraisal value, or D. Borrower's income level? The answer is B. Borrower's hobby preferences. Underwriters focus on factors that influence loan repayment risk, like income, credit history, and employment stability. Personal hobbies are irrelevant. Which of the following is a primary concern of an underwriter when assessing a mortgage application? Is it A. The applicant's marital status, B. The applicant's credit history, C. The local real estate market trends, or D. The geographical location of the property? The answer is B. The applicant's credit history. The applicant's credit history is vital in evaluating their creditworthiness and ability to repay the mortgage, forming the basis for approval or denial that adheres to federal lending guidelines. What is the maximum debt-to-income ratio commonly accepted by underwriters for conventional loans? Is it A. 25%, B. 36%, C. 50%, or D. 60%? The answer is B. 36%. Most underwriters allow for a maximum front-end DTI ratio of 36% for conventional loans, ensuring the borrower can manage debt repayments comfortably without undue hardship. Loan closing and costs. Which document is most critical for detailing all costs associated with closing a real estate transaction? Is it A. Deed, B. Closing disclosure, C. Promissory note, or D. Purchase agreement? The answer is B. Closing disclosure. The closing disclosure is essential as it itemizes all costs involved in the transaction, providing transparency to both parties about fees and charges in compliance with federal regulations. What is typically included in a buyer's closing costs? Is it A. Loan origination fees only, B. Down payment, C. Title insurance, loan origination fees, and appraisal fees, or D. Property tax for the next year? The answer is C. Title insurance, loan origination fees, and appraisal fees. Buyers' closing costs often include various fees such as title insurance, loan origination, and appraisal fees, alongside other potential charges like inspection fees and prepaid interest. Why is a title search conducted during the real estate closing process? Is it A. To appraise the property's value, B. To establish property boundaries, C. To uncover any liens or encumbrances on the property, or D. To finalize the mortgage rate? The answer is C. To uncover any liens or encumbrances on the property. A title search ensures that the property is free of encumbrances such as liens or claims that could affect the new owner's title and right to use the property, protecting the buyer and lender. What is the primary role of escrow in a real estate transaction? Is it A. To guarantee the sale price, B. To hold and manage funds until all conditions of the sale are met, C. To determine property taxes, or D. To perform home inspections? The answer is B. To hold and manage funds until all conditions of the sale are met. Escrow is a neutral party that holds funds and documents during a real estate transaction until all contractual conditions are met, ensuring secure and fair dealing between the buyer and seller. How many days in advance must lenders provide the closing disclosure to borrowers prior to closing? Is it A. 3 days, B. 1 week, C. 10 days, or D. On the day of closing? The answer is A. 3 days. The closing disclosure rule under the TRID mandates a 3-business-day period before closing, ensuring borrowers can review and understand the final terms and costs of the mortgage. Which document itemizes the costs and transactions between parties in a real estate closing? Is it A, the purchase agreement, B, the HUD-1 settlement statement, C, the property deed, or D, the title insurance policy? The answer is B, the HUD-1 settlement statement. The HUD-1 settlement statement, also known as the closing disclosure, includes a detailed account of all financial transactions, ensuring transparency and accuracy. Taxation and assessment. What is the primary purpose of property tax assessments? Is it A, to determine a property's market value for sale, B, to calculate the mortgage payment for property owners, C, to fund local amenities and services through taxation, or D, to verify compliance with zoning laws? The answer is C, to fund local amenities and services through taxation. Property tax assessments are conducted to determine a property's taxable value, ensuring local governments receive revenue to fund schools, infrastructure, and essential services. Which factor can influence a property's assessed value for taxation? Is it A, the property's rental income, B, the property's location, C, the owner's credit score, or D, the color of the property's exterior? The answer is B, the property's location. Property location affects its assessed value, as proximity to amenities and services can increase demand and thus higher tax assessments. How often are property tax assessments typically conducted? Is it A, every 5 years, B, annually or biannually, C, once at the time of purchase, or D, every decade? The answer is B, annually or biannually. Property tax assessments are typically conducted annually or biannually to ensure tax levels reflect the property's current market value. What happens if a property owner disagrees with a property tax assessment? Is it A, they can apply for a refund, B, they have to wait until the next assessment cycle, C, they must immediately pay a fine, or D, they can file an appeal with the local tax board? The answer is D, they can file an appeal with the local tax board. If property owners disagree with a tax assessment, they can file an appeal with their local tax authority to seek a reassessment or adjustment. Which of the following is not typically a criterion in determining a property tax rate? Is it A, local government budget needs, B, national economic performance, C, public services expenditure, or D, number of taxable properties in the area? The answer is B, national economic performance. While local fiscal needs and public service costs impact tax rates, national economic conditions typically do not have a direct effect on local property tax rates.
Stuck on a question? Just think of the Birdsey link in the description as your friendly neighborhood superhero, swooping in to save the day with answers. Feel free to explore it now and return to continue. Simply hit pause, and we'll be waiting when you get back.
Let's proceed by exploring property valuation and appraisal. We'll start by testing your understanding of basic valuation concepts. What is the primary purpose of an appraisal? Is it A, to set a selling price, B, to provide an unbiased estimate of market value, C, to ensure lender profitability, or D, to determine property tax? The answer is B, to provide an unbiased estimate of market value. Appraisals provide an unbiased report estimating a property's market value, crucial for lending, insurance, and other financial assessments as per USPAP guidelines. Which principle of value suggests that too much supply in a market decreases individual property demand? Is it A, B, substitution, C. Contribution, or D. Supply and demand? The answer is D. Supply and demand. The principle of supply and demand indicates property values are affected by the quantity available and buyer anticipation within the marketplace. What is the definition of highest and best use in property valuation? Is it A, the current use of a property, B, a use that results in the highest property value, C, the most practical use of property, or D, the use that minimizes expenses? The answer is B, a use that results in the highest property value. Highest and best use defines the most profitable, legally permissible, physically possible, and financially feasible property use as per appraisal standards. The principle of substitution primarily affects which aspect of property valuation? Is it A, cost approach, B, income approach, C, comparative market analysis, or D, capitalization rate? The answer is C, comparative market analysis. The principle of substitution suggests buyers will pay no more for a property than the cost of an equally desirable alternative, influencing comparative analysis. Which factor is not considered when determining the highest and best use of a property? Is it A, physical possibility, B, legal permissibility, C, market volatility, or D, financial feasibility? The answer is C, market volatility. Determining the highest and best use involves analyzing physical, legal, and financial aspects, but does not directly account for market volatility at the assessment level. Which approach is typically used for valuing a single-family home? Is it A, cost approach, B, income approach, C, sales comparison approach, or D, land residual method? The answer is C, sales comparison approach. The sales comparison approach is ideal for valuing single-family homes by comparing them to similar, recently sold properties in the area, which have comparable features. Methods of valuation. Which of the following methods of property valuation primarily uses recently sold properties for comparison? Is it A, cost method, B, income method, C, sales comparison method, or D, gross rent multiplier? The answer is C, sales comparison method. The sales comparison method involves using recently sold similar properties to estimate the value of a subject property. Which valuation method considers the future income potential of a property? Is it A, sales comparison approach, B, income approach, C, cost approach, or D, market data approach? The answer is B, income approach. The income approach evaluates a property's value by considering its potential income, commonly used in commercial real estate. What does the cost approach valuation method primarily account for? Is it A, depreciated replacement cost of the property, B, projected future income, C, recent sale prices of similar properties, or D, gross rent multiplier? The answer is A, depreciated replacement cost of the property. The cost approach estimates value by determining the cost to replace the property minus any depreciation. Which method of valuation would be most appropriate for a newly constructed building? Is it A, income approach, B, sales comparison approach, C, cost approach, or D, gross rent multiplier? The answer is C, cost approach. The cost approach is preferred for new buildings as it focuses on the current cost to replace the building. Which of the following is not typically part of the income approach to valuation? Is it A, capitalization rate, B, projected rental income, C, replacement cost, or D, operating expenses? The answer is C, replacement cost. The income approach uses projected income and expenses, while replacement cost is associated with the cost approach. What is the main focus of the market approach in valuation? Is it A, cost of land improvement, B, comparable property sales, C, net present value of income, or D, future construction potential? The answer is B, comparable property sales. The market approach, also known as the sales comparison approach, bases value on recent sales of similar properties in the same area. Which method of valuation considers the replacement cost of a property minus depreciation? Is it A, income approach, B, market approach, C, cost approach, or D, sales approach? The answer is C, cost approach. In the cost approach, the property value is determined by adding the land value to the replacement cost of the building minus depreciation.
Don't forget to comment below with your tips, challenges, and thoughts on exam preparation. Your experiences can make a big difference for others.
Comparative market analysis. What is the primary purpose of conducting a comparative market analysis? Is it A, determine the exact value of a property, B, analyze recent sales to estimate a property's market value, C, evaluate the potential profit from a property sale, or D, establish a property's future value? The answer is B, analyze recent sales to estimate a property's market value. A comparative market analysis helps estimate a property's current market value by analyzing recent sales of similar properties in the area. Which factor is considered most critical when selecting comparables for a CMA? Is it A, overall size of the local economy, B, age of the properties, C, recently sold properties within close proximity, or D, the number of bedrooms? The answer is C, recently sold properties within close proximity. Proximity and recent sale data are prioritized in a CMA to accurately reflect the current market conditions and provide a reliable valuation. Why might a CMA need adjustments for a property with a pool? Is it A, pools are universally desired and increase value equally across all areas, B, comparable properties must have identical features, C, a pool can significantly alter the property's market value, or D, pools reduce maintenance costs, impacting value? The answer is C, a pool can significantly alter the property's market value. Adjustments account for unique features like pools, which can affect property value depending on regional preferences and market conditions. What data is least relevant when preparing a CMA? Is it A, current mortgage rates of the area, B, features of similar sold properties, C, the sale date of comparable properties, or D, location of comparable properties? The answer is A, current mortgage rates of the area. CMA focuses on recent comparable sales and property features, while mortgage rates are more related to buyer financing capabilities. In a CMA, why are distressed sales often excluded from valuation analysis? Is it A, they are not recorded in public real estate data, B, their sale conditions can skew typical market value, C, they never align with the characteristics of the subject property, or D, they always sell at full market value? The answer is B, their sale conditions can skew typical market value. Distressed sales, driven by urgent seller motivations, typically do not reflect usual market conditions and thus are excluded from CMAs for consistency. Which of the following best describes a comparable in a comparative market analysis? Is it A, a property with the same square footage, B, a property recently sold and similar in size, location, and features, C, a property of the same age and number of bedrooms, or D, any property in the same neighborhood? The answer is B, a property recently sold and similar in size, location, and features. In CMA, a comparable is a property recently sold with similar characteristics like size, location, and amenities. This assumption helps estimate accurate market values. Source: National Association of Realtors. Appraisal process and techniques. Which of the following steps is crucial in the sales comparison approach to valuation? Is it A, analyzing comparable sales, B, calculating depreciation, C, estimating net operating income, or D, performing a cost-benefit analysis? The answer is A, analyzing comparable sales. The sales comparison approach involves finding similar properties that have recently sold and adjusting for differences. This approach relies heavily on local sales data for accuracy. In property appraisal, what is the first step in the appraisal process? Is it A, performing data analysis, B, defining the problem and purpose of the appraisal, C, conducting a market analysis, or D, selecting evaluation techniques? The answer is B, defining the problem and purpose of the appraisal. Defining the problem, including understanding client needs and identifying property rights, sets the foundation for the entire appraisal process. Which factor is least likely to be adjusted in the sales comparison approach? Is it A, location, B, property condition, C, age of the property, or D, original purchase price? The answer is D, original purchase price. The sales comparison approach focuses on current market values, and adjustments are made for factors affecting market interest, not for the property's historical purchase price. In the income approach to valuation, which concept is critical? Is it A, replacement cost, B, economic obsolescence, C, capitalization rate, or D, comparative market analysis? The answer is C, capitalization rate. The capitalization rate is used to convert a property's net operating income into its value, making it a critical element in the income approach to valuation. What adjustment is most commonly made in the appraisal of multi-unit properties using the income approach? Is it A, vacancy rate, B, lots, C, replacement cost per unit, or D, neighborhood crime rate? The answer is A, vacancy rate. Adjusting for vacancy rates is crucial in assessing the potential income a property may generate, reflecting the likelihood of rental income loss. What is the final step in the appraisal process? Is it A, market analysis, B, determination of property value, C, reconciliation of values for a final estimate, or D, site inspection? The answer is C, reconciliation of values for a final estimate. Reconciliation involves comparing and weighing values from different approaches to form a final opinion of the property's market value. Which method is primarily used for appraising residential properties? Is it A, cost approach, B, income approach, C, sales comparison approach, or D, development approach? The answer is C, sales comparison approach. The sales comparison approach evaluates similar properties that have been sold within the same area, offering an effective valuation for residential real estate. Valuation and finance math. What is the primary method used to determine the value of a property by analyzing comparable sales? Is it A, cost approach, B, income approach, C, sales comparison approach, or D, gross rent multiplier? The answer is C, sales comparison approach. The sales comparison approach is most effective in active markets, using recent transactions of comparable properties to establish a baseline for the property's value. Which of the following best defines capitalization rate in real estate appraisal? Is it A, the interest rate of a mortgage loan, B, the rate of return anticipated on an investment, C, the rate used for tax assessments, or D, the depreciation rate of an asset over its lifespan? The answer is B, the rate of return anticipated on an investment. Capitalization rate is a critical concept in real estate investment, reflecting the investor's potential return derived from the ratio of net operating income to property asset value. If a property generates $25,000 in net operating income annually and has a purchase price of $500,000, what is the capitalization rate? Is it A, 4%, B, 5%, C, 6%, or D, 8%? The answer is B, 5%. To determine the capitalization rate, divide the annual net operating income by the property's purchase price. In this case, you would divide $25,000 by $500,000, which equals 0.5 or 5%. This 5% cap rate indicates the investor's expected return on the property investment. Which factor is not considered when using the cost approach to property valuation? Is it A, depreciation, B, construction materials, C, sale prices of comparable properties, or D, land value? The answer is C, sale prices of comparable properties. The cost approach does not use comparable sales prices as a valuation metric. Instead, it focuses on replacement costs, land value, and depreciation. What is the principle of substitution in property valuation? Is it A, the lowest price a property can sell for in any market, B, the cost to construct a similar property today minus depreciation, C, the value determined by the most recently sold comparable property, or D, the idea that a buyer will not pay more for a property than a similar one in the same area? The answer is D, the idea that a buyer will not pay more for a property than a similar one in the same area. The substitution principle is key in valuation, suggesting a property's value is set by the cost of a comparable alternative. Buyers won't overpay compared to similar properties. When using the cost approach in appraisal, what must be taken into account? Is it A, only the land value using comparable sales, B, the current market value of similar properties, C, the replacement or reproduction cost minus depreciation, or D, operating income from rental spaces? The answer is C, the replacement or reproduction cost minus depreciation. The cost approach values a property based on the current cost to replace it, subtracting depreciation, and adding land value, providing a reconstruction estimate. The term cap rate in real estate finance refers to: is it A, the ratio of net income to operating expenses, B, the net operating income divided by the property's purchase price, C, the annual appreciation rate of a property, or D, the property's mortgage interest rate? The answer is B, the net operating income divided by the property's purchase price. A capitalization rate, cap rate, is a property's net operating income divided by its purchase price, offering a percentage that reflects investment return expectations. Which factor must an appraiser consider for highest and best use analysis? Is it A, all possible uses regardless of market conditions, B, the current physical condition of the property only, C, legal permissibility, physical possibility, financial feasibility, and maximum productivity, or D, the historical uses of the property without considering current trends? The answer is C, legal permissibility, physical possibility, financial feasibility, and maximum productivity. Appraisers assess the highest and best use by evaluating if the use is legally allowed, physically possible, financially feasible, and most productive, maximizing the property's value. A property is expected to generate net operating income of $50,000 annually. If the capitalization rate is 8%, what is the estimated value of the property? Is it A, $500,000, B, $625,000, C, $400,000, or D, $650,000? The answer is B, $625,000. Use the formula property value equals NOI divided by capitalization rate. Here, $50,000 divided by 0.08 equals $625,000. This formula is widely used in property valuation practices.
Notice the code in the corner? When you're stumped by a question, enter it at birdsey.ai for immediate help. Enjoy complimentary study sessions and access to hundreds of additional questions to help you pass your exam with confidence.
Environmental laws and regulations. Which federal act requires the disclosure of lead-based paint hazards in residential properties built before 1978? Is it A, Clean Water Act, B, Safe Drinking Water Act, C, Lead-Based Paint Hazard Reduction Act, or D, Resource Conservation and Recovery Act? The answer is C, Lead-Based Paint Hazard Reduction Act. The Lead-Based Paint Hazard Reduction Act requires sellers and landlords to disclose known information on lead-based paint before selling or renting houses built before 1978. What is the primary purpose of the National Environmental Policy Act? Is it A, to regulate the sale of residential properties, B, to facilitate public involvement in federal decisions affecting the environment, C, to ensure all new buildings adhere to energy efficiency standards, or D, to control air pollution levels? The answer is B, to facilitate public involvement in federal decisions affecting the environment. NEPA requires federal agencies to assess environmental effects of proposed actions and ensures public involvement in the environmental review process. What does the Environmental Protection Agency mandate regarding asbestos during building renovations? Is it A, asbestos must be removed by any demolition crew prior to renovation, B, asbestos does not need to be managed if it is not in a friable state, C, asbestos must be identified and managed in accordance with EPA and OSHA guidelines, or D, there are no federal regulations concerning asbestos handling during renovations? The answer is C, asbestos must be identified and managed in accordance with EPA and OSHA guidelines. The EPA requires the identification and management of asbestos during renovations according to specific safety guidelines, ensuring it doesn't pose a health hazard. Which legislation primarily deals with the cleanup of sites contaminated with hazardous substances? Is it A, Clean Air Act, B, Superfund, C, Oil Pollution Act, or D, Endangered Species Act? The answer is B, Superfund. The Comprehensive Environmental Response, Compensation, and Liability Act, commonly known as Superfund, addresses the cleanup of contaminated sites. What is the function of the Resource Conservation and Recovery Act? Is it A, encourages recycling among local communities, B, regulates transportation of hazardous waste over state lines, C, sets emission standards for motor vehicles, or D, provides guidelines for building energy efficiency? The answer is B, regulates transportation of hazardous waste over state lines. The RCRA sets the framework for the proper management of hazardous and non-hazardous solid waste, including oversight of transportation. Let's move on to settlement and escrow procedures. We'll start with escrow accounts and procedures. What is the primary purpose of an escrow account in real estate transactions? Is it A, to protect the buyer's interest in the property, B, to hold funds for specific use until certain conditions are met, C, to ensure the seller receives funds immediately upon contract signing, or D, to provide a loan to the buyer for purchasing the property? The answer is B, to hold funds for specific use until certain conditions are met. Escrow accounts are used to safeguard money until certain conditions are satisfied, ensuring both parties in a real estate transaction meet their contractual obligations. Which entity usually manages the escrow account in a real estate transaction? Is it A, the buyer's mortgage lender, B, the seller's real estate agent, C, an independent escrow agent or company, or D, the buyer's attorney? The answer is C, an independent escrow agent or company. An escrow account is usually managed by an independent and neutral third party who ensures all conditions of the transaction are met before funds are released. When should escrow accounts be reconciled by an escrow agent? Is it A, yearly, B, semi-annually, C, quarterly, or D, monthly? The answer is D, monthly. Regular monthly reconciliation of escrow accounts is crucial to ensure accuracy and prevent issues with fund management, maintaining trust between parties in a transaction. What happens if an escrow account is mishandled by an escrow agent? Is it A, the buyer can sue the seller, B, the escrow agent is subject to disciplinary actions, C, funds are automatically refunded to the buyer, or D, the transaction is canceled automatically? The answer is B, the escrow agent is subject to disciplinary actions. Escrow agents must manage accounts according to legal standards. Mishandling can lead to legal repercussions, penalties, and loss of licensing for the agent responsible. Which document typically initiates the creation of an escrow account? Is it A, purchase agreement, B, mortgage application, C, inspection report, or D, title insurance policy? The answer is A, purchase agreement. The purchase agreement, a contract between the buyer and seller, usually contains provisions for establishing an escrow account to ensure funds are handled during the transaction. Which of the following best describes how interest is typically handled in most escrow accounts? Is it A, interest is paid directly to the buyer, B, interest is used to reduce transaction fees, C, interest is divided equally between buyer and seller, or D, interest is retained by the escrow agent? The answer is D, interest is retained by the escrow agent. Interest from escrow accounts typically goes to the escrow holder unless there's an agreement stating otherwise. This is to avoid any party gaining unintended financial advantage. Under federal law, what must happen if there is excess money in the escrow account? Is it A, the funds are automatically transferred to the seller, B, the lender must return the surplus to the borrower, C, the lender retains the excess as additional fees, or D, the excess funds go towards the next year's escrow requirements? The answer is B, the lender must return the surplus to the borrower. RESPA mandates that if an escrow account has a surplus exceeding $50, the lender has 30 days to refund the excess to the borrower after the annual analysis. Settlement procedures. What is the primary purpose of the Real Estate Settlement Procedures Act? Is it A, to prohibit discrimination in lending, B, to ensure buyers receive fair and accurate loan disclosures, C, to determine property value, or D, to regulate real estate commissions? The answer is B, to ensure buyers receive fair and accurate loan disclosures. RESPA is a federal law that helps consumers understand the real estate settlement process and mandates disclosures about settlement costs and eliminates kickbacks and referral fees. Which document provides an itemized list of the closing costs required to close a real estate transaction? Is it A, closing disclosure, loan estimate, B, loan estimate, C, truth in lending disclosure, or D, good faith estimate? The answer is A, closing disclosure, loan estimate. The closing disclosure must be provided to borrowers 3 days before closing to review all final terms and charges associated with the mortgage. Under RESPA, how many days in advance must a lender provide the closing disclosure to the borrower? Is it A, 1 day, B, 2 days, C, 3 days, or D, 5 days? The answer is A, 1 day, B, 2 days, C, 3 days, or D, 5 days. 3 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 The answer is C, 3 days. The 3-day period is mandated by RESPA to give borrowers enough time to review all details and fees embedded in the closing disclosure. What fees are RESPA specifically designed to prevent? Is it A, broker fees, B, loan origination fees, C, appraisal costs, or D, kickbacks and referral fees? The answer is D, kickbacks and referral fees. RESPA safeguards consumer interests by prohibiting kickbacks and unearned fees to keep settlement costs fair and competitive. What is the primary objective of the Real Estate Settlement Procedures Act? Is it A, to eliminate referral fees between settlement service providers, B, to regulate the marketing practices of real estate agents, C, to set standardized closing costs nationwide, or D, to determine the legal title of a property? The answer is A, to eliminate referral fees between settlement service providers. RESPA primarily aims to protect consumers by prohibiting kickbacks and referral fees that unnecessarily increase the cost of certain settlement services. It ensures transparency and fairness in the home buying process. Which document outlines the estimated costs in a real estate transaction regulated by RESPA? Is it A, the final closing report, B, the good faith estimate, C, the appraisal report, or D, the mortgage approval notice? The answer is B, the good faith estimate. The good faith estimate was a document intended to provide consumers with an estimate of their closing costs and loan terms under RESPA. It has since been replaced by the loan estimate form. Proration and closing cost calculations. Which of the following closing costs is typically prorated at closing? Is it A, title insurance, B, property taxes, C, recording fees, or D, homeowner's insurance? The answer is B, property taxes. Property taxes are shared between the buyer and seller proportionally to the duration each party owns the property during the tax year. Prorating ensures both parties pay their fair share. In a real estate transaction, which cost is generally considered a prepaid item? Is it A, inspection fees, B, transfer taxes, C, attorney's fees, or D, property insurance premium? The answer is D, property insurance premium. Prepaid items are those costs buyers pay in advance as part of the mortgage closing process. These can include the first year of property insurance premium. Which party is typically responsible for paying accrued but unpaid property taxes at closing? Is it A, the seller, B, the buyer, C, the lender, or D, the escrow agent? The answer is A, the seller. The seller is responsible for property taxes accrued up to the closing date. These taxes are usually prorated, with the seller paying for their portion based on the ownership period. What is the primary purpose of prorating certain closing costs? Is it A, to reduce closing fees for buyers, B, to ensure a fair distribution of costs, C, to expedite the closing process, or D, to guarantee loan approval? The answer is B, to ensure a fair distribution of costs. Prorating ensures fairness by calculating expenses that cover periods before and after the transaction date, allocating them appropriately between the buyer and seller. Which of the following is typically excluded from proration at closing? Is it A, mortgage interest, B, homeowners association fees, C, down payment, or D, rent? The answer is C, down payment. The down payment is paid in full by the buyer as part of their purchase costs and does not get prorated like other recurring costs such as taxes or fees. What is considered when calculating transfer taxes at closing? Is it A, the condition of the property, B, the buyer's financial situation, C, the length of escrow period, or D, the property's sales price? The answer is D, the property's sales price. Transfer taxes are calculated based on the sales price of a property and are part of the closing costs, often imposed by state or local governments.
If you're finding this helpful, please take a minute to like this video and subscribe to our channel for more practice exams, useful tips, and complimentary study sessions with Birdsey.
Deeds and title transfer. What is the primary purpose of a deed in real estate transactions? Is it A, to provide a legal description of the property? B, to serve as proof of ownership transfer? C, to outline property boundaries? Or D, to confirm the sale price of the property? The answer is B, to serve as proof of ownership transfer. The primary purpose of a deed is to provide legal evidence of ownership transfer from one party to another. Which type of deed provides the most comprehensive protection for the buyer against title defects? Is it A, quitclaim deed, B, bargain and sale deed, C, warranty deed, or D, special warranty deed? The answer is C, warranty deed. A warranty deed ensures comprehensive protection by guaranteeing that the title is free from encumbrances and defects. When is title insurance typically issued during a real estate transaction? Is it A, after the home inspection, B, during the mortgage application, C, at the closing of escrow, or D, when the purchase agreement is signed? The answer is C, at the closing of escrow. Title insurance is customarily issued at the closing stage to protect buyers and lenders from any title defects. How does a deed of trust differ from a mortgage? Is it A, a deed of trust involves three parties, B, a deed of trust is only used for commercial properties, C, a deed of trust guarantees title transfer, or D, a deed of trust requires no legal recording? The answer is A, a deed of trust involves three parties. A deed of trust involves three parties, borrower, lender, and trustee, who holds the title until the loan is paid. What does chain of title refer to in real estate transactions? Is it A, a registry of all past property surveys, B, a chronological list of past property owners, C, a collection of property tax records, or D, a record of all building structures on the property? The answer is B, a chronological list of past property owners. The chain of title is a historical sequence listing all previous owners and transfers, ensuring clear and undisputed title. What is the primary purpose of recording a deed? Is it A, to make the transfer of property legal, B, to update the title insurance, C, to determine the type of ownership, or D, to provide public notice of ownership? The answer is D, to provide public notice of ownership. Recording a deed documents the transaction in public records, giving public notice and establishing the priority of the purchaser's claims. This is governed by federal real estate principles. What distinguishes a warranty deed from a quitclaim deed? Is it A, a warranty deed has more promises than a quitclaim deed, B, a quitclaim deed ensures a clear title, C, both deeds provide the same level of protection, or D, a warranty deed can only transfer partial interest? The answer is A, a warranty deed has more promises than a quitclaim deed. Warranty deeds offer guarantees about the property's title and an assurance against claims, whereas quitclaim deeds simply transfer whatever interest the grantor may have without assured clear title. Federal guidelines emphasize these distinctions.
Thanks for joining us today. If you found this video helpful, subscribe to our channel for more practice exams, tips, and tricks. And don't forget to visit birdsey.ai for complimentary study sessions with Birdsey, your AI-powered study partner.